Hey, good morning, everybody. We're going to give everybody just a few minutes to get started or get logged in, and then we'll get started here shortly.
Hello, team. Good morning. And you're mute. Can hear you.
Sorry, I was saying we're going to give everybody just a few minutes, then we'll get started. Um, Today was really just going to be a lot of basic stuff that you guys may or may not know already. And if you guys have questions, put it into the chat, and then at the end, I'll come through and I'll answer each individual question. If we want to dive into certain loans a little bit deeper, or you have questions about repairs or whatever, we'll dive in. But just throw your questions in the chat so we can just kind of get through it. Then I'll answer them all at the end. How many people do we have here? 3. All right, I'm gonna go ahead and get started now. How is everybody doing?
Doing good. How are you?
Good. Is everybody off to a good start of the week, or is the rain bringing you down?
I'm not gonna let it bring it down, but it is a little bit.
A little dreary out.
Yeah.
Okay.
I'm
Well,
from Portland, Oregon, though, so I'm used to it a little bit.
oh gosh, you're used to this then, yeah, for
Oh
sure.
yeah.
Well, today what we're going to do is we're going to start talking about loans, just taking a little bit deeper dive into them and talking about, kind of loans 101, what we should know, the basics. We want to know enough to be dangerous, but not to kind of interfere in the loan officer's job, right? And we don't want to interfere with them, trying to guide them the best way we can. Now, I will say I am a protector at sorts, and I really try to make sure my clients are getting the best deal. So as I am working with the client, I want to see, their loan disclosure. I want to see their paperwork that shows kind of what their rates are going to be or whatever the case may be. Because let's just face it, there's a lot of loan officers that either A, don't know what they're doing, or they charge premiums just to make money on the backside that we can save our clients. And if you can do that, you'll be a hero, right? So we want to make sure we know just a little bit enough to be dangerous. So with that being said, how many of you actually have purchased a home before? Just kind of curious. 1, 2, 3, 4. Okay, so most. I think Sarah's just kind of going through the process. So some of you will know, and this is going to be helpful for you to know if you've purchased a home, you kind of know what you're looking for, right? You want to know, hey, what your loan costs are, how much are you paying is your interest rate, how much points are you paying down to get the rate lower? What is your actual closing costs, and what things contribute to that. So hopefully we have enough time to dive into that, but I just wanted to kind of get a temperature check on where you guys are at with loan knowledge. All right, let's get started. So first off, we're going to talk about conventional. Actually, I want to talk about FHA first. Let's take a deep dive into FHA loans. Okay, so FHA loans is a loan guaranteed by the Federal Housing Administration. So the minimum score that somebody has to have is 580 score, right? So we know that they have to have a minimum of 580. And however, with that being said, there are some lenders that actually can lend with a lower score. I think there's been a new rule, and don't hold me to this, but I think there's been a new rule that the credit score can be a little bit less and the lenders have to work with them. So the minimum, what you're going to hear across the norm, across the industry, is 580 credit score. So pretty low, but it gives clients an opportunity to get into a home that just may be starting out. This is the goal of the FHA loan, right? So this is for somebody, first-time home buyer, and they don't have a lot of money. They're just putting the bare minimum to get into the house. This is a great loan for people that are just getting started. Okay, so the downside of this loan, or the negative, can be the mortgage insurance. The mortgage insurance, or PMI, is like what we like to know it as, is private mortgage insurance, and this is basically the lender's way of building up reserves in case somebody defaults on a loan. Okay, so I'll pick on some people. Let's say Alberto, if I'm a new buyer, how would you explain PMI to me?
Well, usually buyers are really knowledgeable about everything. They just don't want to get to the process for some reason. But I will try to explain with the simplest words possible, like the word a child, right? If you try to use language like too technical, they will look at you like you're talking to me in Chinese. So
Right.
as simple as possible.
So here's how I would explain it. So if I'm talking to you as a new buyer, sorry, 1 second, Dana's calling. So if I'm talking to you as a new buyer, I'm going to explain it to you like this. So, hey, Alberto, listen, the benefits of this FHA loan are that you can put as little as 3.5% of the purchase price, right? So if you're buying $100,000, all you have to do is put $3,500 down, right? That gets you into the home. That's your down payment, so to speak, right? The downside of this loan is that you are going to have a small fee every single month on that loan, which is called PMI, or private mortgage insurance. It's typically going to be anywhere from $75 to $150 a month, sometimes more, depending on the purchase price. And that's going to be on the loan for the life of the loan, meaning it's going to be there forever, right? So what does that fee do? That basically builds a reserve for the Federal Housing Administration in case people start to default, so they can start to pay off those loans and actually, be a profitable company, so to speak. So if somebody pushes back and go, well, I don't want to pay this PMI forever, well, that's when we'll talk a little bit more about that with conventional. But for now, if this is like, hey, we're just getting started, we got a low credit score, I just have just a little bit of money, this is the loan that typically, clients are going to be put into. Okay, so minimum score 580, 3.5% down. Now, the benefit of this is you can actually get what are called concessions from the sellers, right? So we can actually get money from the sellers to help pay down the actual closing costs, and then also the rate, right? So if you are putting 3.5% down and you are using FHA, you can get a max concession of 6%. Does that make sense to everybody? Anybody have any questions about that at all?
No, very simple. I try to make it as simple as possible. People usually ask you for, they ask you for PMI because they say, I don't want PMI. Well, you have to be a conventional, but you're gonna save some money on the PMI, but then you're gonna have to bring more money down, and
Right.
your credit score has to be a lot higher. So it's different loan, right? FHA loan, usually people, first time buyer, usually like they don't even argue about it. But if he has, or the customer has a good down payment, 5-10% down payment, and they got good credit, I think FHA is not the best option in that case.
Correct, right? So that's a perfect segue into conventional. So let's say I keep picking on you, Roberto, because you're top of the screen here, but let's just say Justice is buying a home. He has probably enough. He says, I've got like $20,000 to use towards my purchase, right? And he's trying to be into that, $300,000 price point. I may have that conversation with him and say, listen, you've got two different loans you can go into. You can go into FHA, which, we just covered, or we can go into conventional. So what's the benefit of conventional? So we'll roll through that now. So the conventional loan is regulated by Fannie Mae and Freddie Mac, right? You have to have a higher credit score. So the threshold is going to be 620 or higher. Okay. So they have to have a higher credit score, which just makes them more credit worthy. The mortgage insurance will be there. So the PMI is going to be there until they have at least 20% equity into the home. Meaning if they buy a house for $100,000 and they have $20,000 to put down, that's putting 20% down. That means they have 20% equity in the home, right? So if that's the case, PMI goes away. Now, the benefit of being in the conventional is, let's say that they don't have enough to put 20% down. They're only putting 5, 10, or 15. Once they have enough payments down on the property, maybe let's say 2, 3, 4, 5 years down the road, and the home equity or the home value goes up, now they have more equity. That's when we can tell them, hey, listen, this is actually going to be when you can call your mortgager and say, hey, listen, I've got enough equity. I want to get that removed. And at that time, that will probably be like a refinance or something like that. If they have a lender like Rocket, they will actually just do a home equity evaluation, and then they'll automatically come down. So there's a benefit for working with certain lenders. Okay, so let's just cover the minimum. So the least amount that I've seen right now in the current marketplace is 3% down is the minimum. Okay, so 3% down of the purchase price, or they can go into 5% down. I've seen them go into 10%, 15%, and really they can do as much money as they want to put down at the end of the day, but typically the minimum is going to be 3% down. Now, I have seen from time to time when rates go a little bit higher, or if the market's a little bit slower, some lenders will try to kick up some business and do like a 1% down type program. I don't recommend it, just because you want to have buyers put a little more skin in the game, because the rates are going to be better for them. So let's just talk about the benefit of these different down payment percentages, right? You've got 3, 5, 10, 15%. How does that correlate with how much concessions you can get? Well, if you do 3% up to 10%, you can only get 3% in concessions. Okay, so if somebody's putting, and you guys have to know this when you're writing offers, right? You've got a buyer, they're putting 5% down, they can only ask for 3% of the purchase price. So they're limited. Okay, so sometimes you have to have these conversations with your clients and go, well, hey, listen, if you've got more money to put down, right? Let's say they have enough to put 10% down, but that's everything, every single dollar they have. They may be better going into the 10% down program because their rates might be lower, right? Now they might say, oh gosh, Justice, that's all my money I have. I won't have anything to cover closing costs. That's all right. We can actually ask for more in concessions, right? We can go up to 6%, and now you'll have less out-of-pocket expenses. And we're going to put everything we have into that 10% down so that your rates can be a little bit better, right? So the more you put down, the better your rates are going to be, the better the terms are going to be always. Okay. Does that make sense to everybody? Should we take a deeper dive into the concessions? I know it's important, especially in this climate. Does that all make sense for everybody? Okay.
Remember, FHA has some restriction about renting. I think it's a year or 12 months, you cannot rent the property. You have to live in the property. So if somebody asks you to do an FHA because they want to rent it, not a good idea.
Yeah, so yeah, that's a great point. So let me go backwards and cover that a little bit. So FHA typically in regards to this training, I'm only talking about primary residence. Okay. So if somebody's going to a home, that FHA loan has to be their primary residence, which means they are going to live there for at least 1 year and 1 day, right? So if they plan on buying a home and not living in it, you as an agent can tell them, listen, I can only tell you what it's my obligation, which is you have to live in the home. Should you decide not to live in the home or you decide to do something different, that is totally up to you. That is at your own risk. However, FHA, is typically a primary residence. Okay. So if now where that might change is going to be if they go into an FHA loan for a duplex, right? They're allowed to rent out half, or a triplex, or quadplex or something like that. They can rent out that half and still use that income towards the DTI. So that's another conversation. But for just basic purposes here, these are all going to be considered primary residence. Okay. So if you have questions about concessions, I hopefully think that should answer it. But actually, let's just take a little deeper dive in that. So when we're talking about concessions, and they have, let's say, 6%. That's a lot of money, right? So if they're getting a $300,000 house, they're getting 6%. They're getting probably $18,000, right? So typically that's going to cover all of their closing costs. So what are going to be their closing costs? So I'm going to pick on people just so we're staying active here. So Justice, what is one thing that would be part of your closing costs? Okay, Sarah, give me one thing that's going to be part of your closing costs. Justice, I saw you come on off mute.
Yeah, I wasn't working there for a second.
That's okay.
So the closing costs, I would say part it would be sorry, coming in. Yeah, I got a little lost right there.
Okay, so this is why we're doing it, right? So we can all be proficient. So part of your closing costs are going to be, and we'll say closing costs and prepaid items. So some of your closing costs can be your taxes, right? So you have to put money in escrow so they can actually utilize some of that. And how you're going to word that on the actual additional terms or an addendum is going to be, client's going to get 6% of closing costs of the purchase price, and or toward this could be and or towards prepaid items as well. So I'll put that in the chat later so you guys can see it. So that would be considered a prepaid item. Some of their closing costs could be doc stamps, depending on how you write the contract. Some of it could be loan costs, your appraisal, any kind of fees that are going to be attached to the purchase can be absorbed into the closing costs. Okay. So let me see if I have a copy of an Alta really quick. Okay, I'm going to show you a copy of an Alta statement. This is probably going to be a little bit more helpful for you guys. Give me one sec. Percent. Can we see that? All right, perfect. If for any reason it comes off and you can't see it, just let me know because I'm going to be going back and forth. All right, so let me zoom in here. So if we go towards the bottom, we see we have seller side, we have buyer side, okay? So some of the charges that you're going to see, prepaid interest, credit report fee, third-party processing fee, homeowner's insurance, property taxes, the proration per month, title fees. So these are all of these can be considered closing costs, right? I won't go into each one, but these are all, part of the closing costs that can be used from the title company. Here is your recording fees. This is, the fees that are actually attached to recording the deed with the county, deed stamps, intangible tax, mortgage tax. This is all stuff that they have to pay for. Transaction fees. These can all be part of their closing costs. Okay. So where are you going to see it applied? So if we go back up to the top, this young lady actually had closing costs credit from the seller. She was getting 3%. Okay. She was only putting 5% down. So she's only capped at 3%. So she's getting $6,930 in credits. So if we look at the total credits, her purchase price is $231. Money that she already applied, which was the deposit. This is just the loan amount. Here's your credits. So she's getting that $6,930. She's getting the county taxes credit, right? So she's only paying for what she's going to use, which is basically April 10th through the rest of the year. The sellers can pay their portion. So those are all their credits, lender credit. So this is how we helped them, get over the edge with the DTI. So the lender kicked in a little bit extra money. So the total credits that they're getting, $10,232, and that is basically, you can see how it's getting applied. So all of their total charges came out to $239,000. Well, they're getting a credit of $10,000, so it's just going to be less of that amount. So that's how it's getting applied, right? So you've got two things that the closing costs can be attached to. So there's the closing costs, which are all the things that we just covered, right? Title fees, loan fees, everything like that. Prepaid items, meaning they're prepaying their escrow, are insurance, taxes, right? Those are considered prepaids. Okay. So that's the difference between the two. Is that helpful? Give me a thumbs up if it is. Cool. All right. So going back. Let me see if this is showing now. Loan types is up. I wish I had a bigger screen. Okay, so we're good to go. All right, so going back to the loan types, we've covered conventional, we've covered FHA. I'm going to go to VA just because we don't use USDA too often, so we'll cover that last. So basically, VA is what? That is a benefit that any veteran has that has been honorably discharged from the military. Okay, so that's an important word to know. Honorably discharged. So honorably discharged means that they served their terms, they left the military, and they left in a satisfactory state, meaning they weren't like court-martialed or they didn't, not finish their terms or anything like that. So how do we get that information? How do they prove to everybody that they have these VA benefits? Anybody know? You guys are a dry bunch. You guys haven't had coffee yet?
Repeat the question.
How can a veteran show or prove that they have VA benefits?
Is it through their local VA office?
That's a start, right? But there's a form that they can actually present to the lender that shows what they're eligible for. It is called a DD-214. That number one will show you, hey, they've been honorably discharged and they are eligible for VA benefits. Okay. The second thing that they're going to need to get is what we call a COE, which is a certificate of eligibility. Where they're going to get it, they can get it from their military, their VA office, or they can go online and get it from, I believe, one of their benefits systems as well. But the lender should typically navigate that. But that's the two items that they're going to need to have. They're going to need to have their DD-214, that's DD-214, and they're also going to need their COE, right? So these abbreviations and terminologies are important because you want to make it, you want to fake it till you make it, right? You want to make sure that you know exactly what you're talking about. And if somebody says, well, I've got my DD-214, do you need it? You can say, hey, I don't need to see it. Hang on to it. But the lender's going to need to have that, right? They're going to say, do you need my COE? Nope, I don't need that. But listen, you want to make sure it's handy because the lender's definitely going to need that, right? So on that COE, if you guys have never seen one before, it basically tells you exactly what you're eligible for. Up to 300,000, up to 500,000. Sometimes veterans have more than one loan option. They can do 2 or 3 different primaries. So let's say they, Justice is a veteran. He buys a house, but now he wants to upgrade that house, but keep it as a rental. If he still has some eligibility left, meaning he has a balance left. Let's say he bought 500, or about 250 and he has a balance of 250, he can go and he'll be eligible for another 250,000. So they have different caps on what they're eligible for. Okay. So those two terms are important, DD 214 and the COE. Okay. So going back to the credit score or the minimum, there is not an official minimum for the VA. Okay. But most lenders will want to have at least a 580. I've seen as low as a 560. Okay. So that's really important. So I'm not going to generalize military people. I appreciate their service and everything like that. They typically financially are not, 9 times out of 10, they're not usually in a good spot. Usually they have high debt, right? They're highly leveraged and their credit scores are sometimes lower. So this is why they don't have the minimums on there, because, we want to be able to help everybody. Okay. So just kind of keep that in mind when you're working with a veteran. They may want a $300,000 house and maybe their debt to income ratios are too high because they're highly leveraged with debt. You want to make sure you keep that in mind when you're shopping with them. Okay. So, and the lender should be guiding you through that. All right. Going through mortgage insurance, it's not required, but sometimes they have what's called a VA funding fee. Okay. So that fee is almost typically, I see it between $3,000 to $5,000. We call it a VA funding fee. Some veterans will, if they have, they may be eligible to waive that, but typically 9 times out of 10, they're going to have that VA funding fee. The only time it gets waived is if they have what they're considered disabled, right? So if they left the military and they're 100% disabled, which means they're not really able to work, and they left and now they are 100% considered 100% disabled, they may get that fee waived. But typically that is going to be something that's on there. So the VA funding fee. So if you see that on there, you want to make sure that they know what it is, right? So you can explain it, but also that's something that they're going to have to pay for, or it can be financed. So it can be part of the loan. But that's just something that you want to make sure you're aware of. So what's the benefit of a VA loan? Well, typically they don't have to put any money down, right? So they don't have to put anything down. They have no down payment. Now, a lot of the veterans, they leave the military, they go into the private sector, and then they want to use their benefits, and they think, well, I'm not going to have any fees. I don't have to pay for anything. And that is simply not the case. So this is where realtors like yourself are going to have to come in and do some education, right? So there are fees that are attached to purchasing, and some of those fees are going to be what? They're going to be inspections, right? They're going to be the appraisal. Some lenders will waive the appraisal or just put it into the fee, or some will charge for that out of pocket. Okay, so you want to prep them for that. And then typically the VA funding fee is paid for, or sometimes it's wrapped into the loan, but you do have some fees that are attached to that. Also, you want to make sure they know that they may have to get their prepaid items, right? They may have to put their taxes in escrow. They may have to put their homeowner's insurance and pay that up front at closing. So there's going to be some fees attached to that. So the way we can counter that is going to be what? Concessions. Okay, so the benefit of the VA concessions is you can go up to 6%. On this form, I think it says there's no cap on seller paying standard closing costs. So my understanding is that there is a cap. So I'll get some clarification on that. I believe it's 6%. And then anything that's extra. So let's say you negotiate, a certain set amount, and anything that's extra over 6% can be applied sometimes towards the purchase. But every lender is different. So I'll get some clarification, and let me just write all your names down so I get that information to you today. Berto, Sean, Sarah, Sean. Let's see, we've got Brittany and Melania. All right, going back to this. So that's the benefit of the VA is like, hey, listen, you can have a low credit score. There's almost no out-of-pocket expenses, but we talked about some, right? And you can finance the entire thing, which is great, right? So they don't have to use their money towards their down payment. It's better if they do, because then they can have a lower payment and everything like that. But there's not PMI that they're paying monthly, so this is a benefit. Don't be afraid to work with veterans. I love working with them. I don't think they get enough credit for obviously the serving that they've done, but also they a lot of realtors have had bad experiences in the past with veterans because they think they're not going to pay for anything, so they don't want to work with them. I love working with veterans. I just make sure I do my due diligence and educate them up front so they know exactly what they're getting themselves into, so there's no surprises. And you'll find as you're starting to work through more and more clients that they're going to need help with the concessions, right? So the negotiation tactic is very important that you're getting concessions. So if you've got a veteran, 9 times out of 10, let's just plan on getting 6% concessions to help them out to make sure we get everything covered for them. Okay. Now, let's just go into, I think that's it for that part of the presentation. So I want to talk a little bit about going back to these different loans, giving you different scenarios so you know exactly how to play the real estate game when you're making offers. So let's just say Alberto has a client. They are looking for a foreclosure and they're an FHA. They have an FHA loan approval, right? We all should know by now that an FHA home has to be in somewhat decent condition. So FHA, VA, they have to be in somewhat good condition. And what are they looking for, right? They want to make sure that they have working heat or working ACs, right? They want to make sure that the oven is working, that the windows are all operable, right? So if you've got a house that has broken windows, or I'll give you an example. I'm closing on one tomorrow that it was a VA, and we found one of the windows was painted shut, right? So the VA appraiser was literally in the house checking every single window, right? So they want to make sure the house is in good condition. If you see chipped or cracked paint outside, they may ask you to get those sealed, right? So VA and FHA, they can be a little bit more strict as it relates to property condition. So buyer beware. When you guys are doing your showings, make sure that you're taking a look at this house and you're notating certain things, because if you've got this house that is a total hot mess and you're getting a VA loan or FHA loan, you're running a risk of future repairs down the road. Go ahead, Brittany.
Okay, so I was curious. So say the house is all good to go with everything that we're mentioning here, but they have like a separate shed or whatever out there that isn't the best condition. Is that going to be a problem as far as financing, or since it's not like the house that they're living in, that I don't know.
Well, you know what? Honestly, yes, it can be a problem. And here's why. So what do we normally see in a shed? Stay off mute, Brittany, because I want to talk through this with you. So what do you normally see in a shed? Some of the issues that sheds have.
Most of the time, I would say like wood rot is
Okay.
pretty high.
Very
there.
good, right? So we know typically sheds, if they're not plastic or they're not metal, typically they have wood floors. And people don't use the best wood for it, so they typically have wood rot, right? So let's push back on, or let's go back to the VA. Part of the VA requirements, what I was going to talk about, is a termite inspection, right? So it may not have termites, but it may have that wood rot, which is considered a WDO, right? Wood destroying organism, wood rot. So if it has wood rot anywhere in the house, the shed, the exterior, the roof, the gables, the soffit, anywhere in the house, it could come up. So to answer your question, if it has a shed and you see it's dilapidated, then yeah, this could be something that pops up. So at that point, they've got two options. They could take the shed down, or they may have to do the repairs. I've seen both. So typically you want to tread lightly on that. And a lot of people don't think like, oh, I could just get my house and I don't have to worry about the shed. The shed is part of the property.
Okay.
At that point.
That's what I was wondering, because I
It's a
kind
great
of got,
question.
I kind of got both answers. Like, oh, it depends on the appraiser, you know what I mean? But I mean, I'd rather be safe than have any issues with that, I guess,
It's
potentially.
definitely better to prepare, right? So you can
Yeah.
say, listen, hey, during the home inspection, we found that this subfloor or, the side of this had wood rot on it. And typically you want to make sure you have your termite inspection. And so that's when you're doing your negotiation, regardless, FHA, conventional, whatever, make sure that you're getting your termite inspection. So typically, especially you guys here in Orlando, you guys are working with Matt, the inspector, right? And he will typically order everything for you. So if I've got an inspection, I'll say, hey, Matt, I got an inspection coming. I need you to do it on X day, and go ahead and order termite and septic or whatever else I need, right? So he does it. It's one-stop shop for you. So termite inspections are very important, and they are required by the VA. So when they are doing their closing, they have to have a clear termite report. So if you get that termite report and it says, the box says yes, visible evidence of WDO, that means they have wood rot, and typically we see it on the soffit. Does everybody know what a soffit is?
Mhm.
No? So the soffit is going to be the piece of wood trim that's at the bottom of the roof line, right? So if we see that like white area where it's just, you see the roof line come in, you see the drip edge where you have the shingles that go over, and typically there's like a white piece of wood that's underneath it, right? All of that area is considered fascia or soffit. So typically it's wood base for whatever reason, and it typically has wood rot in it. 9 times out of 10, it will definitely be on the report. Okay. So that's, if you see wood rot, right, where the wood looks like it's falling apart, it's kind of wet and mushy, that's wood rot. Typically, it's not termites, it's wood rot, which means it got wet. And the fix for that is they're going to have to cut it out, they're going to have to take it off, they're going to have to replace it with new wood, and then they're going to have to paint and seal it. Right. So it's a simple fix. It sounds scary, but it's a simple fix. But these are things that are super important to know, because when you're doing your showing, this is product knowledge that you can show off, right? Like if you're with a veteran, you can say, hey, listen, hey, you see some of this window trim, it's rotted out. Hey, if you see this rotted wood here in the baseboard, or if you see it in the shed, like Brittany just asked, this is going to come up on the report. This is stuff that we have to tackle, right? So you're not talking negative about the house, you're educating them on what to look for. So by the time you're doing your third, fourth, fifth showing, they're already like, hey, look, Brittany, I saw some wood rot over here on the shed, or I saw it over here on the baseboard, or typically, it's the exit door in the garage, right? Those always have these wood frames. They always get rotted out. So this is just part of that product knowledge. Go ahead, Alberto.
Question. Back in the days on FHA loan and VA loans, there was not a kitchen. There was no loan, meaning cabinets, right? Those any of the policy changes, it needs to be a kitchen in there for FHA and a VA loan, or how that works?
So I haven't sold any houses without a kitchen. So I take that back. I have, and it did come up on the report, and it was something that got kicked back. So we had to cancel altogether. So to answer your question, I don't think that rule has changed. So if you have a kitchen that's, totally been destroyed, there's no cabinets, which shouldn't be the norm, that would not be an ideal candidate for an FHA or VA home. So that rule has not changed. So going back to some of the other things that pop up on these inspections. So let's just talk about VA. So wood rot, termite damage, chipped paint on the exterior, windows that are sealed shut, ACs that are not working. Running water is another one that's been showing up lately, right? So running water in a home, you have to make sure that when the appraisal is going on, that the listing agent knows that they have to have that water turned on for FHA or VA, okay? Another segue, not to go down a rabbit's hole here, but if a lot of you guys in Polk County, you're going to deal with wells, right? So a house, their main water source is going to be a well. That well has to be operable. And sometimes, usually 9 times out of 10, they're going to need a water test for VA, right? So make sure you're getting all that done during your 10-day inspection, right? So as soon as you have that VA contract, you're ordering termite, you're ordering a septic if you have that, and you need a water test, you have to get those three things done. Now, if you're using Matt, the inspector, he can do the water test for you. So that's really important to know, is that you want to make sure you have your inspectors that can not blow up your deals. 1, 2, they know exactly what they need, and they can do the extra stuff for you. So he goes above and beyond. But those are the 3 things that are important for VA. Now, FHA doesn't require a water test. It doesn't require a septic cleaning or a septic test or anything like that. FHA is a little bit more lenient, right? But you're going to see some stuff pop up. So a stove is one of them, AC system or heat. They're going to test that. They're going to check all the doors and windows, make sure that everything's operable. It's a little bit less strict, I should say, than a VA appraisal, but they are going to have some requirements where things are working in working condition. Typically, wood rot's not usually something that pops up on FHA, but you will see doors that are locked, right? So if you've got like a storage unit and it's locked, or if you've got like a closet within if you have a closet within a garage and it's locked or it has a deadbolt on it, that will probably get flagged because they want to make sure they can go in there and check it. Typically, if you have a rusted up water heater, they may flag that. It's a little bit more lenient, but you have to know what to kind of watch out for. So the older homes, lots of issues. You got FHA, just do yourself a favor and stay away. Okay. So when it comes to conventional, there's a lot less restrictions, right? So they can buy a house that is in disrepair. They can buy a house that doesn't have, a full kitchen or something like that. They can buy a house that has, subfloor issues, whatever the case may be. So there's a lot less restrictions. So if you're buying foreclosure or you're showing houses to an investor and they're going conventional, typically you're going to have free reign. But as long as it has the roof, windows, and everything like that, it should be pretty much easier to get into. So I think that's pretty much everything I wanted to cover as it relates to VA inspections, down payment, concessions. We need to go back to USDA. So USDA loans. Has anybody done one on the team yet? Sean has? Okay. Let's start with, where do we find if a home is eligible for USDA? I'm going to share the link with you. So if I have a client and they're like, hey, I want to use a USDA loan. Why? Well, the benefit of that is typically there's no down payment. Where's the damn chat in here? Sorry, I just want to put the link in here. I don't know where the chat is. Here it is. Justice, I'll send you his contact information, Matt. It is, I can't remember for the life of me what his last name is. It's Matt from Amerispec, but I'll send it to you here shortly. So this link here,
Okay,
save this link. This is important. So if, let's say I have a buyer, Brittany's going to be my buyer, and Brittany tells me, hey, listen, I'm using the USDA loan because I don't have a lot of money. Perfect. Okay. Hey, that's a great option to have. Let's just look, because if Brittany wants to be in a certain part of town, regardless of where you live, we want to make sure that property is eligible for USDA. I share this link with the buyers because a lot of times our clients, they send us houses, right? I tell my clients, listen, Brittany, send me any house that you see on Zillow. Just take a picture of it, send me the address, and I'll take a look at it and see if it's going to be a good property for you, or I'll get it scheduled. Now, I share this link with the client. So I'll say, Brittany, here's a link that you can actually check. As you're looking at properties and you want to see if it's eligible for USDA loans, you can actually throw the address in that link, and then you can find out. What does that do for me? That alleviates my time, right? Because I have to stop what I'm doing, go and look in this map and tell them, hey, yes, it is, or no, it's not. So this is important. Give them the tools so they don't have to bug you for stuff, right? So if they have USDA, or they want to know if a property is in a flood map, hey, listen, here's the link to FEMA. Throw the address in there. And if you want to know if it's in there, check it out, right? So give them the tools. It saves you a little bit of time. So anyway, so the USDA loan, the benefits of that is, they can go into this loan with no money out of pocket. So let's take a deeper dive. The minimum credit score for that is a 640 credit score. So they have to have fairly good credit. Mortgage insurance is required, but it's called something different. It's called a guaranteed fee. And it's 1% up front, and it can be financed, or there's 0.35% annual fee. So these are the fees that you have to watch out for. So if somebody's like, hey, I don't want to have PMI, or I don't want to have a fee attached to it, then USDA might not be the best fit. But if they're tight on their cash as far as their down payment goes, and you're in a rural area, this could be a good purchase price, or a good financing option. So it's 0% down financing, and they can get up to 6% concessions. Now, the trick to this, or some of the things to look out for, is USDA loans were intended for people to buy in like non-busy areas, like your rural areas. They are less dense, they're agricultural based, or where we're going to see that. Haines City, certain parts of Osceola County. Who else is on here? Let me see if I have anybody from Ohio. I don't think so. Ricardo's over in the Groveland Winter Garden area. Groveland is all USDA. Leesburg, everywhere like that's not less, or that's less dense, you're typically going to have that option to go USDA. Now, Some of the things to look out for, there are some income restrictions. So if you make too much, you may not qualify, right? So if it's just two single people and they make a bunch of money, they're probably not going to qualify. But typically I see people that have a little bit less money, they're income restricted, or they have lots of children, right? So they have lots of dependents, and that allows them to have a lot more eligibility because if they make more and they have more children, they may fit that certain box that checks off for them to be eligible. Okay, so I don't see a lot of USDA in Orlando. I would say probably none at all. So some of you Orlando people, this may not hit as much for you, but if you start to sell in Davenport, Haines City, Groveland, Claremont, this stuff may come up. Okay, so this is definitely something that you want to know at least. Not all lenders can do USDA loans. So if you have a client that's USDA, I don't think Zillow Home Loans does them. So you're going to have your own lender for that, which you guys have all been introduced to lenders, so that should be no problem. So let's cover some questions and talked a lot. Do you guys have any questions? Let me check the chat. You guys wanted Matt's name, so I'll put Matt's contact information. So the name of the company is Inspect Central Florida. His name is Matthew Helms. His phone number is going in the chat now. He works everywhere: Tampa, Lakeland, Polk County, Orange County, Osceola County. He will go anywhere for us. Okay. Why I like working with Matt is he does not blow up my loans. He's a general contractor in his past life. So in his past professional career, he was a general contractor. And so he has a lot of construction knowledge. So when little things are showing, mildew or a broken door handle or something like that, it doesn't get turned into a big deal. He'll tell your buyer, listen, this is not a big deal. This is a $5 fix at Home Depot. This is easy, right? So it's important that you work with somebody that makes the inspection process easy. Also, he'll schedule the inspections for you. He'll schedule the termite inspection. If you need a septic, he'll do all that. He's one-stop shop. So I really like working with him. So if you have questions, you can always reach out to him. We'll have him come out and teach a class, things to watch out for inspections wise, but he's really good to have. So how about anything else? No? Okay. So a couple of takeaways. If you don't know about concessions, or you have some more questions about that and you're afraid to talk about it on the group chat, that's fine. Just call me individually. I can walk you through it. If you're not super clear about the ALTA statement, how many of you can read an ALTA statement proficiently to your client and give them an understanding of it? Yes? Anybody that needs help with that?
I'm getting there. I'm going to go over it again today, and I'll reach out to you if I have any questions.
Okay. Very good. So I will put, if I can, I don't know if I can put a PDF in the chat. I'll send you a copy of the ALTA that I have, and you can kind of go through that one. So when I'm looking at an ALTA, what I'm looking for are, obviously, number one, we're checking our commission, right? Our commission always gets screwed up. Number one. Number two, we want to make sure that the transaction fee is there. Number three, I look for are the taxes. Were the taxes prorated correctly? Okay. Also, I make sure I know exactly who's paying for what, right? So were there lender credits? Are there certain credits that my client should have that are not on that side, right? So I've seen where title companies have given the buyer the doc stamps, or they've given them certain fees that should be on the seller side. It's your job to make sure that you're protecting your client and they're not overpaying for stuff, right? So you're their second ears and eyes on everything. Also, you want to make sure the taxes are prorated correctly, right? So you should look back at public records to see, hey, like if the taxes are $10,000, but on the tax, on the actual ALTA it says 7 or 8. If there's a gap, well, your buyer's going to be on the hook for that, right? Also, you should know, and I always point this out at every single closing, the taxes are prorated, right? So we all know taxes get paid from the year before, right? So all the taxes that we're having closings for now, they're all projected. So the title companies are usually good about projecting what the next actual taxes are going to be. Some are not, right? So some will say, oh, it should be this amount. If it's ever going to be more, so let's say you have a closing in April. Well, come October, the new tax bill comes and it's way more than it should be. This previous seller is still responsible for paying those taxes. So you have to contact that title company and say, hey, listen, these taxes are higher than they're estimated. We need to get a check back from the seller to pay for that balance. Right. So that's super important that you can talk about that and you know that. So we will have a title company come out and do a training as we start to get more and more busy. I want to make sure you guys have that basic knowledge, but definitely jump into the Alta. Make sure you can proficiently talk about it. And the fees are where they're supposed to be. Okay. All right. So we know USDA, VA, FHA, we covered all that. The minimums as far as down payment, we know exactly how much concessions that we can get. Right. So we covered a lot. If you have individual questions, I'll stay on. But if not, you guys have the gift of time done for the day. I hope hopefully this was helpful for you. If you have questions, just stay on.
I do have questions. Yeah.
All right. Go for it.
Years ago, there was some conventional programs, right?
Mhm.
It's different conventional programs, right? There's some of them that give you the chance to buy out the rate. There's other that make you pay interest only for the first 3 years. You know, different programs that banks creates to create more volume, I believe, for more customer. There's
Sure.
any special programs that you know that are going on right now based on the market we're living in right now?
Yeah, that's a great question. So we have a couple that I'm seeing right now in the marketplace. Number one is going to be, they call it the two by one or two for one loan, which basically means it could be it could either be like a 2 for 1 or 3 for 1, which means basically they're going to pay either the first 2 years or the first 3 years. It's going to be at a lower interest rate. So we're seeing that advertisement, new construction, hey, it's 3.9 for the first 2 years, or it's basically the first 5 years or something like that. Those are basically like ARMs, right? Adjustable rate mortgages. So basically, you know, they have this brand new shiny house and the client see this 3.9 and they're like, oh, I can have this 3.9. It's like the old days. Well, they need to know that after the first 5 years, it's going to adjust to the market rate, or they're going to have to refinance. So if I put Brittany into that loan, this adjustable rate mortgage, and I don't tell her, listen, you're going to have to refinance and there's going to be some fees attached to that, they're going to have a major shock when they go to do a refinance and they got an $8,000 fees attached to it. So you have to make sure that you're preparing them for that, or negotiate more closing costs and get them a better rate up front for the life of the loan is probably the best angle, right? So if I'm advising a client, because we're advisors, I might say, well, hey, if you get this 2 for 1 rate buy down, or this 3-1 or 5-1, whatever you call it, first 5 years are great, but what happens after that? Well, it goes up to market rate. The market rate 5 years from now could be 6, it could be 2, it could be 1. We don't know, right? So I might say, well, hey, if we just get more money from the seller and we just buy down the rate and we get it to 4.9 for the life of the loan, your payment's going to be higher initially, but for the life of the loan, you're never going to have to refinance. So they may be in a better position. So I'll give you an example. So I closed on a townhouse with Pulte, and they gave me a 4.9 rate if I put 10% down, or 5% down or more. So I went through that process, but I did also sell in the same community. I had another client who, instead of it being 4.9, they actually paid an extra $10,000 and got it to 3.9 for the life of the loan. Okay. So that's an option for clients. They can always pay to get the rate down. Also, there is a loan by ViStar, which is a credit union that is for basically like hometown heroes type folks. So doctors, nurses, surgeons, pediatricians, anybody in the medical field with a license, like a tech, like a surgical tech or something like that, they are all eligible for this loan. There is no PMI on the loan, and it's 0 down payment, right? So it's almost like a doctor loan. So doctors, when they graduate college, they're typically they're usually high in debt because the loan costs are so high, right? So they've got $100,000, $200,000 in debt. So these banks give them these no PMI or no down payment loans because they know these doctors are good for it. They're going to be doctors. They're going to be high net worth individuals down the road. So they take that risk. Well, this loan program through ViStar is basically the same thing, but they're opening it up for other fields. So they're allowing these nurses, they're allowing these, surgeons, or they're allowing pediatricians, veterinarians, anybody like that. Also teachers, they can get into these loans with no PMI. So if you just reach out to anybody at the ViStar, they can share that information with you. That's one that I know of. I stay away from interest-only loans just because, I don't know if we're really preparing our clients the best way for interest-only. I want to make sure they have a plan for the life of the loan, right? So I don't think about just that one individual sale. I want to make sure they're good for the next 5 to 7, 10 years because people trade up, right? So my perfect client is a trade up buyer. I want to make sure that they're prepped and that they're ready to go so that when they want to upgrade, where they're in a good situation. So I kind of stay away from them. I don't work with a lot of investors, but there are some investor loans where it could be income only, or they're just looking at assets, or those are called DSCR loans. I'm not well versed in them because I don't really do them a lot. But if you do have clients that are investors and they want investor only type loans, bank statement loans, which means they don't have a W-2 or they don't have a really good tax return and they're going to just show their assets, you can use that option as well. So if you need a lender for that, I have a good one. I'll put that in the group chat now.
What about those loans that I hear of that they don't require income verification? Do you know anything about it?
Income verification, I would just attach that to the bank statement loan. It's typically what I see. Hold on one second. X.
Because those 1099s people like us, it's not easy to buy a FHA, right? So sometimes the requirements are really, really high, and there's some loans that I know there's no income verification. Of course, I'm sure they're going to be higher interest rate. They're going to be a lot of stock to do. You got to bring probably a lot of down payment, but I want to know about it.
So here's what I'll tell you about these investors. Number one is you got to be careful because they take up a lot of your time, right? There are loan products for everybody that's out there. So in particular, like what you're asking about, like no employment verification, foreign national type loans. If I have a client, it's a one-off, I'll pitch it to the lenders that I have in my network. Which I'm trying to find for you. 1 second. She can tell you a lot more about it than I can. Let me get my vendor list. Bear with me. Her name is Caitlin Schneck. And if you're looking for that type of loan, she's going to be your go-to. It's your bank statement loans. It's your and I'll give you an example. So I closed one with her. It was a bank statement loan only because the buyer didn't have good tax returns, right? They didn't show a lot of profit for their business because they're self-employed. So we had to use their bank statement loans, which shows that they have certain amount of deposits per month that show that basic income, that consistent income. And so that worked for them. Now, specifically, can you ask your question again, exactly what kind of loan it was?
No, I know it was a conventional, but they said there's no income verification. So I was kind of really, those loans are coming back. So that's why I'm asking you all those questions, because I'm not sure what kind of
Yeah. So as far as like some of the crazy loans that were done back in like 2006, a lot of those did go away. No income, no assets. I don't put anybody in that loan because it's really dangerous. Interest only. I stay away. I will do a DSCR, which is like a bank statement type loan. if it's an investor or something like that, that's pretty savvy, then I'll hook them up with Caitlin. So anything in particular that you're looking for, I would just call Caitlin and say, hey, I got your information from Angel and this is what I'm looking for. She could probably answer your questions better than I can, but I typically deal with the norm most of the time, just because that's my perfect client, right? Those are the ones that close more quickly. Those are the ones I really want. So you just got to be cautious with some of the investor stuff because you can run down a rabbit hole really quick with these guys. You're trying to help somebody and the loans, you're trying different lenders and it sucks up all your time. And at the end of the day, it may not be worth it for you. What else? Go ahead, Sarah. You guys don't have to raise your hand. Just shout it out if you got questions.
I have an unrelated question related to the transaction that I'm doing now. Is it okay if I ask you that now, or should I do that later?
Go ahead.
So we did the inspection and the water heater was a problem. So those like negotiations after the inspection, is that like a certain form, or do I just like send that in an email?
So you're going to do a addendum to the contract, right? So
Okay.
all your your formal repair requests will go on an addendum. So both parties sign, that makes it official.
Okay.
Now, if let's say we've gone through inspections, right? We've gone through inspections and we identified the water heater's not working. And then we go through the appraisal stage and then we find out, well, hey, now there's chipped paint, there's termite damage, there's a broken shed or whatever. That's going to be an additional addendum that's done. It's a new addendum. So we're not going to go back and add it to the old one. It's a new addendum. That's a new negotiation. That's part of the loan requirement now. Okay, so it's separate.
Okay. And then what is the form that I use for assigning to a LLC?
The form. So
Yeah, is
on
there
the
like a
contract,
document that
you're
I
going
filled
to
out?
check. On a contract, you're going to check that the box can be assignable. So you're going to check that the contract can be assigned.
Okay, yeah, I
Right.
did that when I
Okay.
initially, but now it's like the LLC's formed, the paperwork is being like finished up in Florida. So what is the next step for me to get the LLC onto that?
A new addendum.
Okay.
So you're going to have to put all parties agree, buyer and seller both agree that the new buyer name shall be changed to X.
Okay. And that should be in the agent resources?
Well, depending on what software you use, this should be in your transaction desk. If you're using that, if you're using Dotloop, it should be in that, or DocuSign, or you can just always ask Caitlin. She can give you a copy, but it should be in your system already.
Okay. Yeah, I
And if I
asked
have to make
her,
a
I reached out,
recommendation,
but she
I
hasn't
highly
said
recommend.
anything.
Yeah, just give her some time. She'll respond back to you.
Okay.
But I recommend Transaction Desk. For me, it's the easiest. I know some of you guys use DocuSign, but for me, Transaction Desk is easy. The stuff is there. Just a click of the button. It auto-populates what I need from public records. So it's really, a good source of, it helps me with my time, right? So I don't have to spend a lot of time manually typing stuff. So anyway, what else?
That was it
Alrighty.
for me.
That's it. All right, guys. Well, I'll let you have your day back. I appreciate you jumping on. If these topics are good, let us know. If you're looking for other topics, throw it in the chat. Just put it in the group chat. These are always things that we want to just keep on adding, so we're all well versed. But great questions. I love the interaction. So if you guys need something, give me a shout. See you guys.
Thank you.
Yeah.
Have a good day.
Bye.